Welcome, everyone. You know, the world of finance, with all its talk about futures and options, it can feel like this really complex maze, right? Maybe something only for the insiders.
Yeah, it definitely has that reputation.
But what if I told you that behind all that jargon, there's actually a set of tools, surprisingly practical tools, built for very real-world reasons. Tools that can give you, well, pretty profound insights into risk and opportunity.
That's absolutely true. These aren't just, obscure things for high-frequency traders. The principles behind them, they actually give you a powerful way to think about managing exposure, making decisions, even spotting hidden opportunities.
Exactly. And that's really our mission today. We're diving deep into equity futures and equity option strategies, our goal, to really unpack how these instruments get used for hedging, for trading, and even for arbitrage. We want to give you a shortcut to being genuinely well-informed on this.
Think of our source material today as like a detailed playbook for these strategies. It gets quite specific.
It does. So, okay, let's unpack this first part. Futures contracts.
Yeah.
They sound intimidating, maybe, but at their core, they were created for something really practical, managing risk.
Yeah, fundamentally.
Think of it as just a way to lock in a price for something you plan to buy or sell later.
And what's really fascinating is how they've evolved. From primarily risk management tools, they become these powerful instruments serving all sorts of market objectives. Mitigating risk, yes, but also outright speculation and even capturing those technically risk-free profits through arbitrage.
Let's start with that basic purpose then, hedging, locking in future prices, reducing uncertainty. We'll use examples from our source, and just a note, it uses Indian rupees, RS, for its figures.
Okay.
So first up, a long hedge with stock futures. Let's say you plan to buy 1,500 shares of ABC Ltd. On June 20th, but the funds won't arrive till then. The current price is RS 455. The risk is obvious, right? The price could shoot up.
Right. So to counter that, you could take a long position in a futures contract today. Let's say the June 29th expiry contract is trading at RS 457.30, and the lot size, that's the number of shares per contract, is 1,500. You'd go long one contract.
Okay, so June 20th arrives, you get your funds, you buy the shares in the spot market, that's the regular market for immediate delivery, and let's say the price did jump, maybe to RS 520, buying the shares costs you more.
Crucially, that long futures position you held, it would have gained quite a bit in value.
Ah, okay.
So when you close out that futures position, the profit you make there effectively offsets the higher price you paid for the shares in the spot market. Your net cost per share, when all said and done, ends up very close to that initial futures price you locked in, around RS 456 in the source example.
And what if the opposite happened? What if the price fell, say, down to RS 390?
Well, then your spot market purchase is cheaper, which sounds good initially, but your long futures position would show a loss. Yet even when you account for that loss, your net effective cost per share still works out to be very, very close to that original futures price. Again, around RS 456 in the example.
So the real takeaway isn't just avoiding a price hike. It's about getting, well, almost price certainty in a volatile market.
Exactly. Certainty. It lets you plan your capital, your business operations, knowing roughly what your future costs will be regardless of market swings.
That makes a lot of sense for planning. But what about the flip side? What if I'm planning to sell stock in the future and I'm worried the price might drop?
Good question. That's where a short hedge comes into play. It's designed to hedge the price risk of a planned future sale.
Okay.
Imagine you need to sell, say, 1,200 shares of PQR Ltd. On July 10th. Maybe you need the cash to repay a loan. The current price is RS 16ND. Your risk is the price falls before July 10th, and you get less cash than expected.
So to protect against that fall, you'd take a short position in the futures contract.
Precisely. If the July futures are at RS 1706 and the lot size is 600 shares, you'd short 2 contracts to cover your 1,200 shares.
Right.
Now let's play it out. If the stock price does fall, say to RS 1440 by July 10th, you'll receive less when you sell your shares in the spot market.
Yeah, that's the worry.
But your short futures position will have made a significant gain because the price went down. That gain helps offset the lower spot price. Your total effective selling price per share ends up very close to the price you locked in with the futures, around RS 1705 in the sources scenario.
And if the price unexpectedly goes up, say to RS 1800?
Then you get more from your spot market sale, which is nice. But your short futures position will show a loss. After accounting for that loss, though, your effective selling price per share still remains very close to that initial futures selling price, around RS 1704.
So again, it's about locking in that price,
Yeah.
providing certainty for future cash flows, whether the market goes up or down.
Exactly. It helps an investor effectively fix their selling price in advance.
Okay, and futures can also hedge a whole portfolio, right?
Yeah.
Against what's called systematic risk, the risk affecting the whole market.
Yes, absolutely. Imagine you have a fairly diversified portfolio, maybe 90 lakh rupees worth of large cap stocks, and let's say its beta is 1.3.
Beta, that means it tends to move about 1.3 times as much as the overall market index.
Correct. So if you're worried about a general market crash dragging everything down, you can use index futures.
How?
You'd take a short position in index futures. The source material calculates, based on the portfolio value and beta, that you might need to short around 13 index futures contracts.
And the benefit.
If the market does crash and your stock portfolio loses value, the profit you make from that short index futures position can help offset those portfolio losses. It dampens the blow from a broad market downturn.
Okay, so futures are clearly powerful for protection, for certainty. But what about using them more offensively? If you have a strong gut feeling about where a stock's headed.
Now we're talking speculation. And yes, futures are a major tool for that, mainly because of leverage.
Leverage.
Right. So if you're bullish, you expect a stock price to rise. Let's say a trader thinks XYZ Ltd will go from RS 110.90 up to RS 1350.
Right.
They could buy the stock outright, but that takes a lot of capital. Or they could go long futures. A single futures contract might represent, say, 850 shares, but you only need to put down a fraction of the total value as initial margin, maybe 20%.
So you control a large position with less upfront cash.
Exactly. And the source shows this clearly. Buying those 850 shares might give you, say, a 3.6% return if the price moves as expected. But that long futures position, because you only put up the margin, could potentially yield a return of almost 18% on your initial outlay for the same price movement. That's leverage magnifying your gains.
Wow, okay. But I assume that cuts both ways.
Oh, absolutely. Leverage is a double-edged sword. It amplifies losses just as dramatically as it amplifies gains. Speculating with futures is definitely not for the faint of heart.
Right, and what if you're bearish? You think stock's going down?
Then you can go short futures. Let's say a trader expects RSB Bank stock to fall from Rs 15925 down to Rs 1520.
Instead of trying to short the actual stock, which can be complicated, involving borrowing shares.
Correct. They can just short a futures contract. It's much more straightforward. And again, leverage applies. The source gives an example where this bearish bet yields a return over 23% on the initial margin put down.
So the key takeaway here is futures let you easily express a bearish view, a bet on prices falling, without actually owning the asset.
Precisely. It opens up strategies that would otherwise be difficult or impossible for many investors.
Okay, so hedging, speculation. What was the third thing you mentioned? Arbitrage.
Yes, arbitrage. If we connect this to the bigger picture, futures also allow for exploiting tiny, temporary mispricings between the theoretical fair price of a future and where it's actually trading in the market.
Like finding a loophole.
Sort of. It's based on established pricing models. The first type is cash and carry arbitrage. This opportunity arises when the traded futures price is higher than its calculated fair price. It's overvalued.
Okay, so the market price is too high compared to theory. What does the arbitrager do?
It's a simultaneous two-part trade. They buy the underlying asset, the stock, in the cash market, and at the exact same time, they sell a futures contract on that stock.
Buy low in theory, sell high in futures.
Effectively, yes. Let's use the source's example. Stock A is RS 1500 cash. The 3-month future is trading at RS 1550. But based on interest rates and time, the fair price is calculated as RS 1534. The future is clearly overvalued.
Right.
So the arbitrager buys the shares at 1500 and sells the future at 1550.
And what happens?
The source shows this locks in a guaranteed profit, roughly RS 15 per share in this case, no matter where the stock price actually ends up on expiry day. The profit comes from capturing that initial mispricing after accounting for the cost of carrying the stock, like interest costs.
Guaranteed profit sounds good. What's the catch?
Speed and cost. Transaction costs matter, and you need to execute both legs, buying the stock and selling the future simultaneously. Any delay in the mispricing might vanish.
Okay, so that's when the future is overpriced. What if it's underpriced?
That leads to reverse cash and carry arbitrage. This happens when the traded futures price is lower than the cash market price or lower than its fair value suggests. It's trading at a discount.
So the strategy reverses.
Exactly. You buy the underpriced futures contract and simultaneously sell the underlying shares in the cash market. This assumes you either own the shares or can borrow them easily, which adds another layer of complexity.
Let's see an example. Stock B is RS100 cash, but its 1-month future is only RS90.
Right, seems too cheap. An arbitrager would buy that futures contract and at the same time sell the actual shares of stock B in the cash market.
And again, a locked-in profit.
Yes. The source example shows a profit of around RS10 per share, plus any interest earned on the cash received from selling the stock. Again, execution is key. You might even unwind the position before expiry if the prices move back towards their fair value sooner.
These sound like opportunities mostly for big players with fast systems.
Largely, yes, the speed required is immense. It just shows how efficient markets generally are at correcting these tiny deviations very quickly.
Are there other kinds of futures arbitrage? Maybe not involving the cash market directly?
Yes, there are calendar spreads. This involves looking for mispricings between futures contracts on the same underlying asset, but with different expiration months.
Ah, so comparing, say, a June future with a July future on the same stock?
Exactly. The idea is to profit if the spread or the price difference between those two contracts is out of line with what it theoretically should be.
How does that work?
Let's say a stock is at RS120. The near-month June future is trading at RS121.30, but its fair value is calculated at RS120.80, so it's a bit overpriced. The mid-month July future is at RS121.50, but its fair value is 1 to 121.61, slightly underpriced.
Okay, so one's too high, the other's too low, relatively speaking.
Right. So the arbitrager would short the overpriced near-month future and simultaneously go long the underpriced mid-month future.
Betting that the price difference between them will narrow or widen towards its fair value.
Precisely. It's not a bet on the overall direction of the stock price, just on that spread normalizing. These are typically low-risk, low-return strategies.
But still hard to execute.
Very. Again, simultaneous entry and exit of both legs are crucial. These mispricings are often tiny and fleeting.
Okay, so futures offer this incredible range hedging, speculating arbitrage. But now, let's bring in options. How do they add to this picture? They seem to offer even more flexibility.
They really do. Options add another layer of sophistication. They give you even more precise ways to manage risk or express a particular view on the market, often with defined risk and reward profiles right from the start.
Defined risk-reward. That sounds appealing. Let's talk about some option trading strategies. You mentioned spreads.
Yes, spreads are a cornerstone. They involve combining options, buying one, selling another on the same underlying stock, usually of the same type, either calls or puts, but with different strike prices or different maturity dates.
Strike price being the price at which you can exercise the option.
Correct. So first, we have vertical spreads. Same expiry date, different strike prices.
Okay.
If you're bullish, but maybe want to reduce the upfront cost of just buying a call option, you could use a bull call spread. You buy a call option with a lower strike price and simultaneously sell a call option with a higher strike price.
What does that achieve?
It lowers your initial cost because you receive premium from the call you sell, but it also caps your maximum potential profit if the stock price really takes off. The source gives an example. Max profit might be RS176, max loss limited to RS124.
So defined risk and reward. Is there a bullish spread using puts?
Yes, the bull put spread. Here, you short a put option with a higher strike and buy a put with a lower strike, again for a bullish view. You typically receive a net premium upfront. Your max profit is that premium, while your max loss is also capped, maybe at RS409 in the example if the price falls sharply.
And for bearish views?
Similar structures. A bear call spread involves shorting a lower strike call and buying a higher strike call. You collect premium, hoping the price stays below the lower strike, but your risk is capped if the price rises unexpectedly.
Okay.
And a bear put spread means you long a higher strike put and short a lower strike put. You pay a net premium, hoping the price falls, but your maximum profit is capped, while your maximum loss is also limited, the net premium paid.
So these vertical spreads manage risk by combining options with different strikes. What about different expiry dates?
Those are horizontal spreads, also called time or calendar spreads. Same type of option, same strike price, but different expiry dates. The goal here is usually to profit from the difference in how quickly the time value of the options decays.
Time value, the part of the option premium related to how much time is left until expiry.
Exactly. And then there are diagonal spreads, which combine different strikes and different expiry dates. They get more complex, often seen in over-the-counter markets.
Okay, spreads seem to be about fine-tuning a directional bet or managing cost. What if you're not sure about direction at all, but you expect a big move?
Ah, that's where strategies like straddles come in. They're essentially bets on volatility, not direction.
How do they work?
A straddle combines a call option and a put option with the exact same strike price and the exact same maturity date.
Buying both or selling both.
Both are possible. A long straddle means you buy both the call and the put.
Why would you do that?
Your outlook is you expect a significant price move, but you're just not sure which way up or down. Maybe there's a big earnings announcement or some major news pending.
So you profit if it moves sharply either way.
Correct. Your maximum loss is limited to the total cost of buying both options, the premiums paid, say, RS-393 in the source example. But your potential profit is theoretically unlimited if the stock price moves significantly above the strike plus the premium, or significantly below the strike minus the premium. Those are your break-even points.
And the short straddle, selling both.
That's the opposite bet. You sell both the call and the put at the same strike and maturity. Your outlook is that you expect the stock price to stay very stable, not move much at all.
So you profit if it stays flat.
Yes, your maximum profit is limited to the total premiums you received upfront, again, maybe RS-393, but, and this is crucial, your potential loss is unlimited if the price makes a big move in either direction. Selling straddles is a high-risk strategy.
Unlimited loss. Okay, noted. Is there a slightly less intense volatility play?
Yes, that would be the strangle. It's similar to a straddle, betting on a big move, but it uses options with different strike prices. Typically, you use an out-of-the-money call, strike price above the current stock price, and an out-of-the-money put, strike below the current price, but still with the same maturity date.
A long strangle, then, means buying both this OTM call and OTM put.
Exactly. You still expect a substantial market move, up or down. The main advantage over a straddle is that it's usually cheaper to put on, as OTM options cost less.
What's the trade-off?
Your maximum loss is still limited to the total premiums paid, maybe RS-285 in the example. Your potential profit is still unlimited. However, the stock price needs to move further than with the straddle before you start making a profit, because your strike prices are further apart, your break-even points are wider.
And the short strangle, selling the OTM call and OTM put.
Same logic as the short straddle. You expect the price to remain stable, ideally between your two strike prices. Your max profit is the premium received, say RS-285, but again, your potential loss is unlimited if the price moves significantly beyond either strike. Like the short straddle, it's high risk.
Okay, these trading strategies are fascinating. But you mentioned options can also act like insurance. How does that work for hedging?
Yes, they can be very effective for hedging specific risks. The general idea is pretty straightforward. Buying a call option can protect you if a price unexpectedly rallies for something you might want to buy later. And buying a put option protects against an unexpected drop in something you already own.
Like insurance for your investments. Let's look at some specific hedging strategies. What's a covered call?
A covered call is quite common. An investor already owns a stock, that's the covered part. They have a long position, and then they simultaneously sell a call option on that same stock.
Why sell a call on stock you own? Doesn't that limit your potential profit if the stock goes up?
It does. That's the trade-off. The main reason is to generate extra income, the premium you receive from selling the call. This income can effectively lower the net cost of owning the stock or just provide a bit of extra return.
Can you walk through an example?
Sure. Say you buy stock at RS-1590. You then sell a call option with a RS-1600 strike price for a premium of RS-10.
Okay.
Now, if the stock price rises above 1600, say to RS-1640, your stock gets called away at 1600, your profit on the stock is capped at that RS-10 gain, 1600 strike 1590 cost. But you also keep the RS-10 premium you received, so your total net profit is RS-20 per share.
And if the stock price falls, say to RS-1520.
You lose RS-70 on the stock. 1590 costs 1520 current price. But you still keep that RS-10 premium. So your net loss is reduced to RS-60 per share instead of RS-70.
So it gives you some income, slightly cushions the downside, but caps your upside.
Exactly. It restricts potential gains while leaving the downside risk largely intact, though reduced by the premium. That's why the choice of strike price is important. A higher strike gives more room for stock gains, but yields less premium.
Is there a way to protect against that downside risk more effectively when using a covered call?
Yeah, you can extend the covered call into what's called a collar. To limit the downside, you add a long put option to the strategy.
So now you're long the stock, short and out of the money call, and long and out of the money put with a lower strike than the call.
Correct. Building on that last example, long stock at 1590, short the 1600 call for RS-10 premium. Now, let's also buy a put option with a 1580 strike for, say, RS7 premium.
What does buying that put do?
It puts a floor under your potential losses. If the stock price tanks, you can exercise your put and sell at 1580. Your maximum loss is now significantly reduced in the example. It becomes just RS7 per share.
Ah, so much less risk. What's the cost?
The cost is that buying the put reduces your overall income from the strategy. Your maximum potential profit also drops. From RS20 in the covered call example down to RS13 with the caller. It's a direct trade-off. Less risk for less potential reward.
Makes sense. What about a more straightforward insurance policy? Just protecting stock you own from falling.
That's the protective put. It's very intuitive. You own the stock, long position, and you simultaneously buy a put option on that same stock.
So long stock, long put, what's the goal?
Pure portfolio insurance. You want to protect your existing holdings against a significant price drop, but you still want to benefit fully if the price goes up. It's an alternative to just selling everything or using futures.
Okay, example time. Buy stock at RS 1600 and also buy a put option with a 1600 strike price and at-the-money put for a premium of RS 20.
Right. Now, if the price falls sharply, say to RS 140, you've lost RS 70 on the stock. But your 1600 strike put option is now worth at least RS 70, 1600 strike 1530 price. The gain on the put offsets the loss on the stock.
So your maximum loss is just the premium you paid for the put.
Essentially, yes. In this case, max loss is limited to that RS20 premium. But if the price rises, say to RS 1660,
then the put option expires worthless.
Correct. But your stock has gained RS60. Your net profit is that RS60 gain minus the RS20 premium you paid, so RS40 profit. You still participate fully in the upside, less the cost of the insurance.
So unlimited potential gain, limited defined loss. That sounds pretty good.
It's a very powerful strategy for risk management and sometimes called a synthetic long call because the payoff profile looks just like owning a call option.
Okay, one more hedging-related one. The butterfly spread. You mentioned it relates to limiting the risk of a short straddle.
Exactly. A short straddle has unlimited risk if the price moves too much. A butterfly spread aims for a similar goal, profiting from low volatility, but with strictly limited risk and limited profit.
How is it constructed? Using calls, for instance.
The standard call butterfly is you buy one call at a low strike price, you sell two calls at a middle strike price, and you buy one more call at a high strike price, all with the same expiry date.
Buy one low, sell two middle, buy one high. Okay, example.
Long one call at 6,000 strike costs, say, 230 premium. Short two calls at 6,100 strike receive 150 premium each, so 300 total. Long one call at 6,200 strike costs 100 premium. Your net cost is 230, 300 plus 100 equals 30.
So a net debit of 30. Where do you make money?
You make the maximum profit if the stock price finishes exactly at the middle strike, 6,100, on expiry day. In that case, the 6,000 calls worth 100, the two 6,100 calls expire worthless, and the 6,200 call expires worthless. Your payoff is 100 minus your initial 30 costs, so a profit of 70.
And the maximum loss?
Your maximum loss is limited to the initial net cost, 30 in this case, and occurs if the price finishes below the lowest strike, 6,000, or above the highest strike, 6,200. It's a defined risk, defined reward strategy, betting on the price staying within a specific range.
And you can build these with puts, too.
Yes, or even a mix. Very flexible, but definitely more complex to manage.
You know, hearing about all these relationships, calls, puts, stock prices, time, it really highlights how interconnected everything is. Are there ways to profit directly from those relationships if they get out of line?
Absolutely. That brings us back to arbitrage, but this time using options. The key concept here is put-call parity.
Put-call parity. Okay, what's the essence of that?
It's a fundamental equation in options pricing. It describes a specific relationship that must hold true between the price of a European call option, European put option, the underlying stock price, and the risk-free interest rate, assuming they all share the same strike price and expiry date.
A mathematical relationship.
Yes. The formula basically says the price of a call option plus the present value of the strike price should equal the price of a put option plus the current stock price. C plus XEERT equals P plus S0.
Okay, I don't need to memorize the formula, but I get the idea. These things should balance out in a specific way.
Exactly. And if, for some reason, the market prices deviate from that balance, if one side of the equation doesn't equal the other based on current market prices, then a theoretical risk-free arbitrage opportunity exists.
How would that work in practice?
Let's take the sources example. Stock is RS1251. A one-month call option with a 1240 strike costs RS47.50. Based on put-call parity and an 8% interest rate, the fair price for a 1-month put option with the same 1240 strike should be Rs 223.26.
Okay.
But what if that put is actually trading in the market for only Rs 2023.15?
It's too cheap. It's underpriced relative to the call on the stock, according to the parity relationship.
Precisely. So an arbitrager spots this. They would immediately buy the underpriced put option, simultaneously buy the underlying stock, and simultaneously short the call option. They essentially buy the cheap side of the parity equation and sell the expensive side.
And the result?
Because they locked in prices that were momentarily out of sync with the parity rule, they guarantee a small, risk-free profit when the options expire, regardless of where the stock price ends up. In the example, it's about Rs 0.5 per share.
Again, sounds great, but I'm guessing it's hard to execute.
Extremely hard. You need to execute all 3 legs, buy put, buy stock, sell call, absolutely simultaneously. Any delay, even fractions of a second, and the market prices might move, erasing the opportunity or even turning it into a loss. These are typically exploited by high-frequency trading algorithms.
Right. So moving from exploiting static mispricings to managing ongoing positions, how do professional traders manage the risk of their option portfolios dynamically? I've heard the term delta hedging.
Yes, delta hedging is fundamental for anyone managing a significant options book, like market makers or institutional traders. It's about actively managing your exposure to small changes in the underlying asset's price.
And it involves delta. What exactly is delta again?
Delta is one of the Greek's measures of option risk. It tells you how much an option's price is expected to change for a 1 unit, say RS1, change in the price of the underlying stock.
Okay, so a delta of 0.6 means the option price moves about 60 paise for every 1 rupee move in the stock.
Roughly, yes. Call options have positive deltas, between 0 and 1, meaning they tend to move in the same direction as the stock. Put options have negative deltas, between -1 and arrow, moving opposite to the stock.
So how is delta used for hedging?
The goal is often to create a delta-neutral position. This means structuring your overall portfolio, your options, plus maybe some underlying stock or futures so that its total delta is 0, or very close to it.
Why 0 delta?
A delta-neutral portfolio, in theory, shouldn't gain or lose value from very small, immediate changes in the underlying stock price. It isolates the position from minor market fluctuations, allowing traders to focus on other aspects like volatility or time decay.
How do you achieve delta neutrality?
Let's say a trader is short 10 call option contracts. Each contract is for 50 shares, and the options are at the money, meaning their delta is around 0.50.
Okay, so short 10 contracts, 50 shares contracts, 0.50 delta equals a total delta of negative 250 shares.
Exactly. A negative delta means the position loses value if the stock price goes up slightly. To hedge this, the trader needs to add positive delta to their portfolio to bring the total delta back to 0.
How?
They could buy the underlying stock, which has a delta of 1, or more commonly, they might use futures. Since a stock future has a delta very close to 1, they would need to go long enough futures contracts to offset the negative 250 delta from the short calls. If the futures lot size is also 50, they'd likely go long 5 futures contracts. 5 contracts, 50 shares contract delta of 1 equals plus 250 delta.
So the negative 250 from the calls and the plus 250 from the futures balance out to 0 delta.
That's the idea. But here's the catch. Option delta isn't constant.
It changes.
Yes, delta itself changes as the underlying stock price moves, and also as time passes. This means a position that's a delta neutral now might not be delta neutral in 5 minutes if the stock price moves.
So delta hedging isn't a one-time fix.
Not at all. It's a dynamic process. Traders have to constantly monitor their portfolio's delta and continuously adjust their hedge buying or selling small amounts of stock or futures to keep it close to neutral. It requires sophisticated systems and constant attention.
Okay, that gives a sense of the active management involved. Now, stepping back a bit, are there broader market indicators related to futures and options that traders watch for clues about sentiment or potential direction?
Definitely. 2 key ones are open interest and the put-call ratio.
Let's break those down. What's open interest, or OI?
Open interest is the total number of outstanding futures or options contracts that have been opened and not yet closed or expired. It represents the total number of active positions held by market participants. It's different from volume, which is just the number of contracts traded on a given day. OI tells you how many contracts are actually still open.
Okay. Total open positions and the put-call ratio, PCR.
The put-call ratio is simply the ratio of the number of put options traded, or open interest, compared to the number of call options traded, or open interest, over a certain period. So PCR Put volume call volume or put OI call OI.
How do traders interpret these? Let's start with open interest combined with price movements in futures.
There are some general interpretations, according to the source material.
Hmm.
One, if the futures price is rising and open interest is increasing, it's often seen as bullish. It suggests new money is coming in, establishing new long positions.
Okay, bullish sign.
Two, if the futures price is rising, but open interest is declining, it might indicate short covering. Existing short sellers are buying back contracts to close their positions, pushing the price up, but overall interest is waning.
So less conviction in the rally, perhaps?
Could be. Three, if the futures price is declining and open interest is increasing, that's typically seen as bearish. It suggests new money is establishing new short positions.
Bearish sign.
Four, and if the futures price is declining and open interest is also declining, it often means existing long position holders are selling to get out, liquidating their positions.
Interesting patterns. What about the put-call ratio? How is that used?
The PCR is often used as a contrarian indicator, especially when looking at extreme levels.
Contrarian, meaning you look to do the opposite of what it seems to suggest.
Often, yes. Generally, a PCR below 1 means more calls are being traded or held than puts. Naively, you might think that's bullish, but contrarians often interpret a very low PCR, lots of call activity, as potentially bearish. It might signal excessive optimism or complacency, suggesting option sellers, who are often seen as smarter money, don't expect the market to rise much further and are happy to sell calls.
Ah, okay. So too many people buying calls might be a sign the top is near.
That's the contrarian view. Conversely, a PCR significantly above 1 means more puts are active than calls. While that sounds bearish on the surface, a very high PCR might be seen by contrarians as bullish.
Why?
It could signal excessive pessimism or fear, lots of put buying for protection. Contrarians might see this as a sign that selling pressure is exhausted, and the market might be poised for a rebound, especially if option sellers are willing to sell all those puts.
So it's about reading the extremes of sentiment.
Exactly. It's not a perfect timing tool by any means, but it provides a useful gauge of overall market sentiment that some traders incorporate into their analysis.
Wow. Okay, we have covered a lot of ground today, from using futures to just protect a planned purchase months down the line.
All the way to complex arbitrage strategies, exploiting tiny mispricings, and sophisticated option spreads.
And hedging entire portfolios, speculating with leverage, using options like insurance. It's quite a toolkit.
It really is. And I think the main takeaway is that futures and options aren't just these mystical things for giant trading desks. They offer this incredibly versatile set of tools for anyone, individuals, businesses looking to refine their financial strategies.
Whether that strategy is about managing risk really carefully,
Or speculating on a very specific market view you might have.
or even trying to capture those rare arbitrage opportunities. They really empower you to manage your financial exposure in much more nuanced ways than just buying or selling stock.
Definitely. We've seen the flexibility of futures for hedging, trading, arbitrage. We've looked at all those different option strategies, spreads, straddles, strangles for defined risk-reward trading, and things like covered calls and protective puts for strategic portfolio insurance.
And then touching on the more advanced side, the dynamic risk management with delta hedging, and how traders try to read market sentiment through open interest and the put-call ratio.
So maybe a final thought for you as you reflect on all this. Consider this. How might really understanding this interplay between price, risk, time, and volatility, as expressed through these instruments, how might that fundamentally change the way you approach your own financial decisions?
Could it give you a new lens, maybe, for viewing potential opportunities or perhaps potential threats in the market?
It's certainly something to think about. We definitely encourage you to keep exploring these concepts, maybe reread parts of the source material if you have access, and see how applying this kind of analytical mindset might help you reach your own financial goals.